Let's talk about the big picture with Cem Karsan, joining us from Kai Volatility Advisors, Senior Managing Partner, back with us in studio. Cem, we're getting some weakness today, but of course the market has been surprisingly strong. It's gone against you since the last couple times we spoke.
Not exactly. I think we were pretty clear last time that we would get some type of a pullback at June OPEX, right?
Okay.
We did that. We got about a 2.5% pullback. Not very exciting, right? But the first pullback we'd seen in a while. And we went out publicly on social media and otherwise. We said, look, the vol is not reacting, right? Buy back your shorts. There's a time to stay long until July 19th.
I'm thinking about the vol up, stocks up, and then the rollover, which we never got. That was like the core of the thesis. So
yeah.
Is it still in the timeline? Could it still happen?
The key here, and I want to be very clear, right? We're taking shots in windows of weakness, non-strength, right? You said, why today? Why are we down today? It could be any day, right? Why? Because we ran into July 19th, OPEX, positive on a charm flows, right? What do we see? Since then, we've seen a very kind of sideways to down action. That's typical. It's what we saw last OPEX as well. And so that's what we've been looking for. You take those shots. If vol does not react, if you don't see the movements and the other things that we've been looking for, you take your profits, you move on, you get back into the trend, and you ride the flows, right?
Why don't you think it happened?
In June, why didn't it happen? That's actually a very important thing to talk about. We've been doing quite a bit of work on why the Dutch boy with his thumb in the dike, volatility, implied volatility, has been continued to be pinned, right? There's a lot of vol selling going on out there now, right? There's a lot less hedging than there was a year ago, right? We see that across the board, but why has it been so strong and consistent? We're seeing dispersion levels, the constituents of the index relative to the index itself, moving at record levels in line with 2017 levels. Those are levels that in 125 years of realized volatility that we haven't seen other than 2017 now. And they're happening for the same reason. There is a vol supply that's being sold to the market. In 17, it was a lot of search for yield that was happening in the form of iron condors, the XIV, amount of selling coming from those ETFs was a huge factor. Now it's different, but it's similar. It's structured products. Nobody's really talking about this. But as interest rates go to 5.5%, right, you're now able to sell a structured product that yields 5.5 plus whatever vol selling gets added onto that. 9-10% yields you can get non-correlated in these products relative to a market that's much scarier than it was 2-3 years ago for most. That's very different than selling a structured product that yields 5% in a market that's been making 15% a year.
Okay.
Structured product issuance is through the roof. Banks are getting massive amounts of vol, selling that to the market. These are not weak hands. These are people who are moving out of the equity market.
Okay.
That has actually created a pin in the S&P 500 where the majority of these structured products are tied, and it's creating a massive rotation around the center.
Where is that pin that you see?
So that pin is vol implied vol together, right? If dealers own gamma, at the end of the day, they are buying the market when it goes lower. They are selling when it goes higher. They're also selling more vol as it's not performing, as realized vol comes down to the rest of the market, which itself is a circular chase down the market. But that's specific to the S&P 500. In the meantime, you have AI going through the roof, right? Which means other things have to go the opposite way. That's what leads to dispersion. At the end of the day, if certain things have to go up, right, and the index is pinned, that means other things have to, by arbitrage constraints, go the other way. And that's why we're seeing historic rotations, historic breakdowns in breadth. NASDAQ, as we said, starting in March, started a dramatic outperform because of the short vol complex that was there. We called that rotation. We also, as of 3 weeks ago, said, look, it's over. It's going the other way. And guess what? We're starting to see the other way. And that's because, much like we saw with the meme names a couple years ago, right, a year and a half ago, all the call buying made sense for pushing gamma squeezes at first, but once it got crowded and the prices got too high, they couldn't push it profitably, right? And dealers then begin to profit, and as you get into expirations when that decay hits, right, now the unwind of the deltas starts to come back to dealers. So dealers are selling NASDAQ into big expirations as those calls decay. We're starting to see that. We saw that the last 3 weeks, and now we're starting to see the rotation go the other way. It's not a surprise that oil's bottoming, that the bank stocks are doing better. Everybody has a narrative to why that's happening, but why it's happening is because under the hood, the NASDAQ and the vol markets are actually forcing a rotation with the index itself pinned. So this is what's going on under the hood. It's not just AI earnings, right? It's not just the banking crisis is over. Narrative follows price. We're also seeing narrative now follow price with the market pushing up, right? And a change in some of those things that we've been waiting for.
A big part of another big part of the thesis, though, that you laid out that we talked about was very macro-driven, was something that is sort of out of the realm of the heavy options, convolution. It's something very simple that a guy like me can follow, which was basically the Fed's going to have to stay more aggressive. Rates have to stay higher. It was more of like a strain on the economy that will eventually roll things over, but yet we've kept ripping through level after level for risk on.
Benjamin Graham, right, has a famous quote. Many people here know it, right? In the short term, markets are a voting machine. In the long term, it is a weighing machine. Macro matters. It's not that it doesn't matter. It just matters over longer time frames. You don't ignore macro, right? Because it eventually comes to bite you in the butt. But the reality is we can go on for a quarter, right? And a year even, right? Look at 99. Again, I started the market in 98. 99, 2000, in the last 9 months, the NASDAQ doubled, 100% return before dropping 92%, right? These blow-off tops, which we've talked about, they happen for a reason. Liquidity reflexively is inverse to the positioning. Right?
You think there's still that potential for that kind of blow-off top, even though
we've been seeing it, right? I mean, the market's up 20% on the year.
But we haven't seen the other side of the. We haven't actually had the blow-off. We've had the climbing of the top.
Correct, right? And the reality is that's why it happens, because it's hard. If it was easy, right, everybody was shorting because of the macro and knows what's going to happen, right? Everybody knew the tech bubble was there starting in 98. But you couldn't short it in 98. If you were long it, but then you missed it, you also lost 80%, right? So the timing is critical. Understanding the flows, understanding these windows, the weeks that matter, the days that matter are critical to getting this story right. The macro matters in the long run, but it doesn't mean you can't lose a dramatic amount of money between here and the top. And so if we're talking about timing this day, week, you can't kind of sit here and say, okay, this month you were wrong, right? The question is, what's going on with the flows? How do you dynamically move in and out? I wish we were on the air every week so I could give you, detailed moves each week. But we went out on social media. We're very public about buying back our shorts at the bottom there at the end of June, right? And that we were very positive until July 19th. Guess what? Here we are, July 19th, right? A week ago.
So it's back on.
Until you got about 48 hours, right?
Okay. What do you want to see in that time period?
So today is exactly what we needed to see at the minimum to hold on to our shorts, right?
Okay.
For right now. Tomorrow is a Friday. Fridays are dangerous days, especially in this window of weakness. We're still there,
okay,
right? If this Friday can fall apart, break below the 20-day in the S&P 500 on a closing basis, that opens the window, right, for continued downside going forward. If it can't, right? If it stabilizes here, if vol, which is up right now, by the way, comes down, which is a positive. The vol being up is also an important factor to keep track of. If that vol begins to decline here in the next 36 hours, call it, if the market stays supported, it doesn't have to be up, but it has to be kind of controlled sideways, small down, with vol coming in. If that happens, end of month, beginning of month, Monday, Tuesday are supported because the market is up on the month. There's higher collateral in the market, more buyback coming into that period.
So it's a small window here.
We're catching it at the end, but this is what happens, right? Yeah. It's never easy.
Well,
the market, we're not the only ones talking. We're talking about this, right? People know about this. People are trying to play this. So it's always going to be hard. We were up after the Fed meeting, despite, right, was generally viewed as a hawkish kind of tone. Why were we up? The same reason we're up almost every Fed meeting, regardless of what they say, because you get the vol compression for the event, the von and charm flows. That's exactly what you wanted to see. People we were public about it. You want to be looking to short into that when that happens. The problem is it's not going to make it easy, right? It's not going to happen exactly at the end of the day, beginning of the day. It's going to happen where after people are squeezed, after they're forced to kind of buy back in. And that's what we're seeing. People getting caught wrong-footed, a little bit of a window of weakness, a decline. And this is the window that you play, that you try and take advantage of these things. That's the key. You have to understand these flows, the voting machine in the short term. And that's what we're playing now with the broad macro view.
Right.
Now, that does not mean you do not just bet macro long or short. And that is the narrative that is so wrong about how people manage this market.
The kind of two sides, just real fast because we're almost out of time, but the kind of two forms of sell-offs, and I'm sure I might be missing one or two or several, but the two forms of sell-off that seem to be most resonant in the way I see the market is the melt up of speculation like we got on COVID and the crash down. That's the vol up, stocks up for a little bit that you laid out to us before. Obviously, the vol stayed subdued. That's what you've addressed here. And then the other one is that macro credit's going to tighten, rates are going to stay higher, and you're going to have more of kind of a recession style. So in those two categories, if we simplify them in those two categories, which right now is most compelling to you? Have we disproved the macro thesis? It sounds like you would argue still no.
No, absolutely not. If anything, that we've continued to reiterate and drive higher for longer, right? Yes, everybody's been talking about recession, and we never talked about recession being the downside problem. It's the inflation in a stickier, stronger demand economy that's the problem. We've been pretty clear about that. It's not the old cyclical game people are used to. It's the inflation and the populism that's driving the structural problems with the Fed. The Fed is in a box if they continue to be in that box, which
so
they
rates
are,
up still bad for stocks.
Still bad for stocks.
Okay.
And actually, if anything, more than ever right now because we're about to break out to a new leg higher.
All right. Hey, you came on a nice day to reiterate the case. Nice fade. It sounded like you said just now the fade came just in time.
It's almost how it always works.
Yeah. All right. Well, we also, our calendar seems to be right before expiry. So 2 months ago, it was start to dip your toe. Last time it was layer into shorts, but you said, okay, it didn't take. Now it's kind of, you stab again. And if it doesn't take within the next couple days, then you step aside.
I want to be clear. If you're just sitting here trading monthly based on what we say on here, you're going to have problems, right? You have to understand these windows. You have to be taking your shot, right? If it's not working, you got to be dynamic. You got to be active. Follow us on social media. Try and listen to everything else we're talking about. But you definitely want to be active in this market, looking for the macro headwinds, looking for the opportunities to short it. But play long. You're going to get big, dynamic moves at the end of this market when appropriate, and be active.
Okay.
Be water.
All right. So little Bruce Lee reference there. All right, so we got a little shot-taking moment for bears here. We'll see if it takes, if vol picks up. Thanks for the update, Cem.
As always, great to be here. Thanks,
All right, Mr. Karsan, Senior Managing Partner at Kai Volatility Advisors.